Welcome to the Venture Trends in 2026 Outlook. The energy in the room is incredible. We've had a 50% surge in registration since last year. Clearly, this is a conversation on top of many minds. Thanks for joining us. I'm Sheila Proeve, moderator today and a Stanford engineering alumna. Joining me are leading voices in venture capital. Sale Kwon, partner at Cooley LLP based in Palo Alto, and Hunter Nadler, head of startup banking at JP Morgan based in Boston. Today's format will start with speaker introductions, followed by key themes for venture in 2026. Then we'll open for audience Q&A. Kindly note, this session is for educational purposes only and does not and is not intended to constitute legal or financial advice to you in your specific situation. For such advice, please consult with your own legal, tax, financial, and other professional advisors. I'll launch a quick poll during introductions to guide the speakers. Welcome to our guests, Sale and Hunter. Sale, what's your role and how does Cooley support startups and investors?
Yeah, glad to be back. I'm with Cooley, and Cooley is a law firm that helps more companies with their venture financings and IPOs than any law firm in the country. So we represent about 30% of US-based tech unicorns and about half of the companies listed on NASDAQ Biotech Index. This is my 18th year of practice. I focus on early stage. I help startups on formations, venture financings, and corporate governance all the way through exits, whether that's an IPO or a sale. And I also work with venture capital investors, corporate investors, angel investors, when they're taking interest in putting their money in US-based startups. And always focus on building long-term relationships with clients and enjoy really growing with them over the journey. Thanks for inviting me back to this interesting session.
Thanks. Now, Hunter, what's your role and how does your team at JP Morgan work with startups?
Thanks, Sheila, and hello to everybody. Glad to be here and glad to be back on the panel this year. So thanks so much for the time. So I lead our startup banking business for the East Coast. Our group sits in our innovation economy business, which is inside of our corporate and investment bank at JP Morgan. Specifically, our team works with founders from the earliest stages of their journey, from inception up to that Series A. And we have growth stage and other partners inside of our innovation economy business that work with founders through their whole journey from inception to global enterprise or whatever that measure of success means to them. Specifically, we work day to day on banking, payments, cash management. We work with founders on wealth advisory, pre-transaction planning. We have a cap table management solution. We have offers and partners of vendors with deals and discounts for our clients here at the firm. And specifically, we've got anything you could need from a financial institution as a founder and as running your business. And our job and our team is led by dedicated relationship managers who are former founders, former investors, and operators inside of startups. And they bring with them the empathy and understanding of the founder journey, having it been part of their own career journey, and delivering the scale and expertise of the firm for founders at the earliest incubation of their business. We think it's really important for folks to have partners who can scale with them. And where we start is with founders at the earliest part of their journey with a goal of helping them get where they want to go.
Thank you, Hunter. I'm ending the poll. Appreciate the audience's vibe check. A quick recap: about half are planning to or considering launching a company this year. And about 70% of the investors are planning to deploy capital. Well, let's dive in with today's first theme, AI's second act. What changes has AI brought to startup expectations?
Happy to start with that one, Sheila. I think it's really interesting times because a lot of more established and later stage companies are trying to figure out how to leverage AI. And what we find is the early stage companies can build their business model, tactics, and operations around these AI tools. Number one, to make it easier to get to launching and deploying your product. And two, building that leverage, that operating leverage, and that insight and perspective into their business model. And there's a term that's often thrown around in business, SMBs, small and medium businesses. And the corollary I like to think about for particularly AI native and startup based companies is that AI allows you to be small and mighty as a business. And what we're seeing, not just in AI native companies, but in a lot of startups, they're able to get more out of each employee. And my favorite way to think about measuring that is either equity dollars per employee. Folks who have raised capital, they're able to be more efficient with the resources for their employees as they pursue their KPIs and business objectives. And the second piece, the trailing and next lagging indicator, is that revenue per employee. And there's a lot of great content out there talking about big, larger established companies, revenue per employee, and traditional SaaS-based businesses, the revenue per employee. And in AI companies, which are raising an outsized amount of capital, we're seeing the revenue per employee of those companies scale dramatically faster. And ultimately, the efficiency and the enterprise value and those things is really driving a lot of interest in that sector. So the ability for you to start with a clean slate and building in the leverage of these amazing tools to start your company's foundation at that place allows you to benefit from those efficiencies in a way that other folks are trying to retrofit those tools into their business. I think that that's really the key, most interesting thing about being a startup founder today with all of these tools that are out there.
Now, PitchBook data shows non-AI startups represented 60% of the deal count, but only 35% of the deal value through the third quarter of 2025. How sustainable is this AI premium?
Yeah, I think that the sustainability is something that is a great question to throw around there. How long can this go on? What's clear is that the market forces are at work and that there's a lot of capital out there and a lot of interest in the sector and the impact that it can have on existing companies and other revenue streams and opportunities later. I think that how sustainable it is isn't the question. It's clear that there's market forces that are driving that in competition and otherwise. And what we're not seeing so much is that other sectors are raising less money. It's that the concentration of larger deals are driving up the perception of that in a different way. Venture funding is high, but there's more dollars chasing fewer deals. And so that in turn is raising that enterprise value premium in the sector. And specifically what we're seeing is companies in San Francisco, which is the center of the AI universe for sure, are calling for a real premium over other markets because of how powerful and potent the talent pool and opportunity is and the ecosystem is there. It's really special and amazing, and it's a really great place to be.
Sale, would you like to add?
Yeah, sure. I 100% agree. There is some interesting bifurcation that's happening in the venture market with runaway valuation for certain types of AI companies that's capital intensive, mostly foundational model companies raising big money and big valuation. And then there's the rest of the venture that's operating as usual. I tend to tell people not to be too drawn to the media coverage of certain outlier companies that may not be a great or accurate reflection of what's actually happening in venture. For example, case in point is there is 1-year-old generative AI company that raised $2 billion in a Series seed financing at a $10 billion valuation. That was the largest and still the largest seed financing ever. So those are the ones that get media attention. And people ask me about how those companies are structured and those things, but they're not necessarily a normal company. So as indicated by that, there is definitely growing concern around the AI bubble. When you compare SaaS revenue to valuation multiple 4 to 8x to maybe generative AI multiple, like that often ranges from 10, 50 to 100 from revenue to valuation, it's hard to argue that there is no bubble whatsoever. And interesting thing is this circularity issue that often comes up because big tech is oftentimes the driver of high valuation. They put hundreds of millions of dollars, if not billions, in certain companies, but then those companies turn around and use those proceeds to buy chips or compute back from those big tech and oftentimes sold to them. So there's definitely a circularity issue there. I don't know if that's necessarily a problem, but that's something we see. Also, the other concern people often have is, unlike Web3 boom, that was essentially a small segment of VC that really went in, but this one is industry wide. You can't really find a legitimate VC fund who entirely distance themselves from AI at all. So it's going to be an industry-wide problem if this bubble gets affected or burst, God forbid. And initially, when you talk to investors, they weren't naive. These are very smart people. They don't think all the companies that they're investing at big valuation is going to succeed, but at the same time, they have this FOMO. They know this is going to be big and they don't want to miss out. So nowadays, people are looking at numbers and profitability, especially because compared to SaaS companies, generative AI companies, for example, have much lower margin on average. I think the question comes down to, no one really doubts that the technology has great potential and promise. And the only question in my mind is whether the industry can attain the vision and economic sufficiency before the enthusiasm and capital that they've raised run out. So ultimately, bubble or not, everyone knows not all highly valued AI companies will survive or at least maintain their valuation. And the question is whether I invest in the right ones.
Now, what are moats for AI startups going forward besides being a first mover?
I think we're going to find out, really. But what's important for folks, and we've seen that have had interesting traction, is there's the larger generalist players that we can all know and think about. I think that similar to varying success in SaaS and other sectors, the folks in AI who have novel and unique data sets who can deliver insights using the power of these AI tools to deliver outsized value and outcome to their customers are going to be able to stand out. I think that what's first mover might feel like the right place to start, but if the tools everyone is using to build and catch up are constantly improving at a pace that can outpace your customer delight and traction, is going to be hard to understand. So I really think that differentiated data and the differentiated value that you're providing to your customers is going to create stickiness and loyalty. Because I think that, and one of the things that we're talking a lot about is the fidelity of legacy software as a service business and those tail of revenue, those contracts, the renewal rates, the churn. The AI tools themselves, whether or not they're delivering that same service, the ability to shift providers and the grunt work associated with turning vendors or shifting accounts or changing a CRM system or doing that, AI tools are incredibly powerful. And so I think it's your ability to create that stickiness and defend the value that's going to be the challenge for companies. And it's also the opportunity for folks who can do things using this new technology that was too hard to do years ago, that was maybe even too hard to go weeks or months ago. But because of the steepness of the curve in terms of the capabilities of LLMs, of agentic tools, and otherwise, the power here is really important. And I think that differentiated value, that differentiated data is what's going to be key, because that's what's ultimately going to power the decision making and the value for end customers, and hopefully will help defend the stickiness of future revenues and relationships with those customers.
Further thoughts, Sale?
Hunter essentially covered everything I was going to say. But there was a time when every founder or tech founder got the Google test, like, why can't Google do this better than you, right? And recently I think OpenAI launched ChatGPT Health, so that would make some companies very nervous, some application layer companies nervous, because now these big foundation companies are looking into specific industries and how to leverage their kind of power into that. As Hunter said, most application companies that I work with, they try to find a killer use case. And with it, that can be a segment of users, that can be a segment of industry like advertising. Users can be social media influencers and so on and so forth, and develop distinguished features custom tailored for their target audience and market. And then once you build a community around that, that suddenly gets the network effect going. So you have something that can be a very attractive acquisition target. And what that also does is that gives you some unique, very valuable data set that other more generic foundational model companies wouldn't have access to. So that would be how you can potentially distinguish yourself, but it's to be seen.
Now, shifting to the theme of manufacturing liquidity, what have been some notable sources of liquidity in 2025, and what should investors be watching for?
Yeah, I can take that. So just statistically, I think more exits happen in 2025 versus 2024, which is good. But a lot of them were not necessarily true exits because, as I said, a lot of companies raised lots of money and at a lofty valuation. And when you think your stock is valued high, obviously it would be beneficial to you to try to acquire companies with your stock. So we've seen a fair amount of stock acquisitions, and it's not a true liquidity event because the consideration here is private company stock. And also, private companies tend to stay private longer. So secondaries are definitely gaining more attention, and more people ask about that. But ironically, hot companies and investors are not dumb. They know there's that growing interest, and they started policing and trying to exercise more control on secondaries by requiring board approval and other contractual restrictions before anyone can sell. So if there are secondaries, I see most of them happen in a more regulated way. It can be through company-sponsored tender offer or company-sponsored secondaries. Again, as I said, I think in prior sessions, that company support is super critical if you want to do a healthy secondary. And some tips to that, when you're trying to sell, is not the right time to see if you have documents. And a lot of times it sounds pretty basic, but you'd be surprised how many times people don't have documents relating to their transactions. So try to make sure you have signed, dated, compiled execution copies in your records at all times, including all exhibits. Also, think about secondaries early on, because a lot of times when you try to sell, you then look and learn your restrictions, meaning the restrictions you're subject to. That's probably not the right time. When the right time would be when you buy in. When you buy in is the time to learn about those restrictions, and maybe there's some room for negotiation to get them waived or so on and so forth. So that's another thing that I see a lot of people try. A lot of times, and there's definitely growing use of special purpose vehicles. And when you look at big companies like SpaceX and whatever, there are a lot of people who are trying to syndicate and then try to set up an SPV and have SPV take equity stakes. And there's nothing legally wrong with it. It's just there are some extra considerations because those SPVs are legal entities, legal persons on their own. So they have terms. And usually there is an operating agreement or LLC agreement that defines what kind of voting power you would have as a member of the SPV, because you don't have direct access to the target company. It's indirect through the SPV. So you have to learn the terms so that you understand what kind of information or control, and those things will be pretty critical. And when the company exits, how the distribution would occur, and that thing would be also very important.
Thanks, Sale. Now, what are you noticing about venture rounds and scaling capital overall?
Happy to jump in on this one. I think what's really interesting is that historically, big private companies that we're talking about today, SpaceX and others, and that we're seeing out in the market, would have gone public much sooner because there wasn't as robust ability to raise capital at scale in that way. So what we're seeing more is that companies, private companies, are getting large, sophisticated investors engaging with them earlier. And so as a founder, as you're thinking about starting your company this year, you said 50% or so of the audience was considering that, is what can you foundationally put in place, a nod to Sale with corporate governance being a critical part of that, is that the professional management and expectations, whether not saying that public company and reporting and all those pieces, but the likelihood that you have highly sophisticated investors and operators in your company sooner than you might otherwise, how can you as the founder be prepared to interface with those types of investors to represent your company and keep yourself in the C-suite in the long run? Those advisors, partners in your orbit need to be there to help you think about how to stay in control, how to stay the face of your company in the long term, and having the right partners that can rally around and see around those corners in the meantime. And a very basic thing, having the right financial plumbing in your business, having the right legal partners, having the right folks around you to help you navigate that. Because what we're seeing is early companies taking off and raising preemptive and larger rounds on a tighter timeline, particularly in AI. it can get unwieldy for an early stage founder, particularly a first time founder and otherwise. And so we think that it's just incredibly important that you have great advice around you as you think about the prosecution of the business, and the evolution of that capital stack can become highly sophisticated a lot sooner with companies taking off at this pace that we're seeing.
Thanks for highlighting the important planning element. Sale, would you like to add anything on IPO?
Yeah, I think lots of people are heartened by the fact that there are a lot of big financings happening in the private world, so companies don't have to go public, but that's on the company side. Investors need more IPOs because although NAs are more, greater in number, when you look at transaction value per transaction basis, IPOs are a way to go because that's how big time liquidity would occur. And secondaries are mostly one-offs. So that's not going to be a solution. The good news is that, as everyone knows, interest rate has come down quite a bit. And there has been some increase in IPO activities on the tech side in 2025, which is also encouraging. And who knows, maybe the Supreme Court will invalidate tariffs, right? In which case, maybe that will reduce uncertainty around US trade policies, which I think would be a positive to the stock market at least. And then, as Hunter said, there are a lot of companies gearing up for IPO, and we're talking about if they really go public, hundreds of billions of dollars being liquid, if not trillion, right? So this is going to be really important and critical for the venture industry to regain its prominence in 2021. But there are some skeptics as well, and folks talked about this reopening of the IPO market for the last 2-3 years hasn't occurred in earnest just yet. So hopefully this year will prove them wrong or prove them right. And also some recent big time tech IPOs didn't perform as some people had hoped. So it's a lot of cautious optimism out there.
And the last thing I'll just add, Sheila, to that commentary, when we think about exits, whatever it may be, IPOs, M&A, and otherwise, there's been less of that in the last few years. And historically, that the recycling, as we'll call it, of that capital, where you've raised money towards a company and those exits and the proceeds filtering down through employees. There's lots of headlines around how many millionaires were created through different transactions, depending on the company and things. But that capital recycling is good for LPs who want to invest and lean in on those funds. It's exceedingly powerful. Many of these great companies that scale and exit or IPO and beyond create wealth and return capital to those employees, and the rapport and culture and incubation of other ideas, project teams and engineering teams and otherwise, who spin out and start new companies. It's part of helping to do that. There's the PayPal mafia and different mafias in various markets of folks who have created that. It's not just those individuals, but the proceeds of these companies and the potential liquidation of a lot of this stuff is a really powerful fuel for great companies, great ideas, experienced people who have experienced those different life cycles in companies. And it can be a great deliverer of talent, where you have folks who maybe have been personally de-risked, who are, from a financial perspective, who are willing to lean in on earlier companies, who are willing to do different aspects. And that culture and community building inside of these companies upon those exits is really powerful for helping the next generation of first-time founders coming through with that experience. And so it's really exciting to think about some of that being unlocked in a way that has been a little more bottled up in the last couple of years.
How are acquihires changing the dynamics of venture investing?
Yeah, I think it's a super interesting topic personally. Acquihires, for those who are less familiar, it's about acquisitions with the primary purpose of acquiring a team. But as that implies, if you're talking about acquiring a company, you obviously acquire a team. So by the fact that you're focusing on the team, you're implying that there's not enough business or assets outside the team. So that's why traditionally acquihires were limited to a situation where the company wasn't all that valuable. And last year proved them wrong, because now we're talking about billions of dollars of acquihires. And VCs were always team first. I mean, that has, as far as I'm concerned, never changed, but it's more heightened in the hottest AI companies because the value isn't even in the IP, it's in the team. So when you look at NVIDIA's acquisition of Grok, Google's acquisition of Windsurf, Meta's acquisition and investment in Scale AI, it was all acquisition of the team was the motivator. Typically, it comes with obviously team moving to the buyer, and then there's going to be IP licensing. A lot of times it's non-exclusive, so it avoids the change of control, because change of control often trips when you do exclusive licensing, and the buyer gets a release of claims by the seller, so that by recruiting the core team, they don't get sued. But sometimes there's not even like IP licensing component, so it takes different structure. And the structure has become especially popular with big tech because, as you can imagine, big tech is often monopolies and there's a lot of antitrust concerns. But if you structure it such that you're just recruiting team, sometimes that helps them avoid antitrust scrutiny. And regulators are catching on, but still the acquihire structure is known to be beneficial from an antitrust perspective. So investor perspective, you really don't want to invest in a company when the buyer can acquire them without really acquiring them. Right. So because that would leave you holding the bag, unfortunately, and a lot of attention on negotiating protections around, hey, like you can't just buy the team because I invest in this company primarily or almost exclusively based on the team's quality. So that's a pretty interesting legal development. People are putting a lot of money in that structure. And I think something's going to happen from regulatory or contract perspective to make sure those transactions are also covered when you talk about investor protections.
Now, moving to the new frontier theme, let's get to actionable insight. What's likely a promising sector for 2026? And please don't say AI.
Yeah, we've talked a lot about AI. I think that what we're seeing a lot of outside of that space is around security and resiliency, and the way the geopolitical winds are blowing, the way various rivalries geopolitically and otherwise, there's a big focus on supply chain and having it be more domestic, more controlled, less risk, less spread out. Clearly, there's a lot of interest in that sector from a defense, dual use perspective, from energy and efficiency, from all these pieces. There's a huge focus on reshoring, less sort of global reliance in what was the cheapest or the easiest way to make something happen and spreading things out, but concentrating those, particularly supply chains, manufacturing, I think ingredients, whether those be rare earths or otherwise. There's a ton of investment in building those tools and access and resources out. And the tools, to help identify those, the tools to forecast what could play out, and the insights into all of the ancillary services and business and needs that those companies will uncover are amazing. And I'd be remiss not to bring up our JP Morgan itself has a security and resiliency initiative, which is a $1.5 trillion effort over the next 10 years to lean in and lend and finance across those strategic and resiliency initiatives, and lots more to talk about in addition to a $10 billion equity commitment from the firm and making direct investments into companies that are helping to lean in on security and resiliency initiatives here. And that's where we're seeing a lot of interest and traction, not just because of the initiative, but because of the way the winds are blowing and the focus on companies seeking not just the cheapest way to make something, but the way that is the most certain and accessible and nearby, that is really driving a lot of investment and interest in that. It's pretty exciting time across there.
Delaware was indisputable for startup formation. What changed?
Yeah, that's a pretty interesting topic. So Delaware's supremacy as the go-to state to incorporate companies has recently been challenged by states like Nevada and Texas. And there's a little bit of history here, but there are some very interesting instances, kind of cases on point. So one thing I would talk about is what happened to Elon Musk's pay package, because there's a little bit of history. So in 2018, he gets a pay package in the form of equity grant. At that time, it was valued at $2.3 billion. And 6 years later, in 2024, it's now valued at $56 billion. And then Delaware court rescinds it and strikes it down. So you can imagine his reaction to that. And the court is questioning the fairness, and Tesla goes back to its disinterested stockholders and got that pay package approved after the fact. But then Delaware court still stood firm and said, oh, our decision to rescind stands. And also in an unrelated transaction, but at about the same time, there was a case called Moelis. And in that case, Delaware court essentially struck down a stockholder agreement clause saying it unduly constrained the board's authority. So what happened is sophisticated investors were to get some rights, and that was contractually agreed to. But then the court second guessed it and essentially said those are unenforceable because that's undue restriction on the board's authority. So this was super surprising to a lot of people because Delaware traditionally was a jurisdiction that respected sophisticated parties' negotiation and its outcome. And Elon Musk wasn't happy. So Elon Musk reincorporated Tesla to Texas. And also VC heavyweight like A16Z or Andreessen Horowitz also reincorporated to Nevada and even recommended its portfolio companies to start their companies in Nevada. And seizing this opportunity, Nevada and Texas passed certain laws that would make them more attractive destination jurisdictions for incorporation. But Delaware wasn't standing idle, they reacted. So Delaware legislature passed some laws to override the court's decision in Moelis. And I think it was last month that Delaware Supreme Court essentially restored Elon Musk's pay package. And at that time, it was valued under $40 billion. So that was probably good news. So at this time, Delaware still stands as the dominant destination jurisdiction. And I believe that dominance will probably continue so long as the state responds to these challenges timely.
Now, how has cash management for founders, how has that evolved in the last year? What are you seeing?
Yeah, we're all familiar with some of the market disruption and banking issues of 2023. And I think that a few things have happened. One is there's a number of choices from banks and fintechs and otherwise out there. There's no shortage of folks that want certain aspects and can have highly delightful experiences for founders to solve a near-term problem or have a great customer experience or UI, UX, et cetera. And what we really focus on and thinking about and working with our founders is to think about your financial stack the way you would think about your technology stack. What is going to have the opportunity to scale and have the security and have the resiliency and have not just the solution that's going to solve you something for this month, this week, this quarter, this year, but what's going to be the right partner and the right toolkit for you in the long run. We talk a lot about how that can evolve and change, and it's critical that folks, particularly using the comments from earlier around how quickly companies can grow in their sophistication from the board level, on the scale of their companies, on the density of their customer and payments, and the orchestration of all that is critical. And thinking about that financial stack in the same way you're thinking about your tech stack is really the right way to think about it. And we're happy to talk to anybody about what are the best practices in leaning in and figuring out those solutions. Our goal is long-term scalable solutions for founders and helping them get where they want to go.
Now, based on the earlier poll, which showed about 50% of the audience was looking into starting a company and several looking into deploying capital on the investor front, what are new policy and regulatory changes that founders and angels may have missed in the last year?
So obviously what comes to my mind is the One Big Beautiful Bill Act and how it expanded the QSBS benefits. So for some audiences benefit, QSBS stands for Qualified Small Business Stock. And if you acquire stock that is deemed as QSBS and sell for profit, the capital gains, substantial part of it, if not all, can be excluded from federal taxation. So that's the benefit. And it can be a massive benefit too. What happened is that the One Big Beautiful Bill Act made it easier for you to get that QSBS treatment. So for example, if you acquired stock after July 4th of last year, then the minimum holding period is now 3 years versus 5 years. Obviously at 3 years, it kind of kicks in partially, and then it goes up to 75% and 100%, but it's better than 5 years. And also maximum benefit amount used to be the greater of $10 million or 10x of your cost basis. And now it's $15 million or 10x of your cost basis. So imagine being able to exclude $15 million of capital gains from federal taxation. That's a material benefit. And also, as the name indicates, QSBS is for stock issued by small companies. And the definition of small used to be the company should have less than $50 million of gross assets. Now it's raised to $75 million, which makes it also easier to get QSBS. So that means there may be more potential tax savings, and people are looking for liquidity even more strongly based on those expanded benefits. Another thing I would flag is OISP. I talked about this before. It's short for Outbound Investment Security Program. So it applies to all US investors. So all US investors investing in companies have to do what is called reasonable and diligent inquiry to see if those companies that they're investing in has a presence in certain countries of concern. And those countries of concern started with China, Hong Kong, Macau, and now it has Russia, Venezuela, and it's ever expanding. And it's not enough to just ask that question. Sometimes it requires a real diligence inquiry. So a lot of people get surprised, and the consequence could be, if it's a willful violation, it could be up to $1 million of penalty or up to 20 years in prison. And obviously, I don't think we have precedent yet, but it's all about when you are investing in a company, you have to ask that question to the company, whether they operate in those countries of concern.
Now it's time for the live audience Q&A. How do you think about the future of climate investing?
I would add just that climate investing, oftentimes climate tech or energy tech, takes a long-term view, and it's quite capital intensive. And that's why it's not where, like, traditionally VCs were very active. VCs were more like, I want to kind of flip quick dollars off of software company, which is not capital intensive, and there are a bunch of buyers. When you think about energy or climate tech companies, it may not be as broad a field that we're looking at, but obviously any field, if you have a good company, no reason not to go in. And there are some very high quality investors who focus on those areas, but that's what I would have to say.
Would you have similar thoughts on the ag tech sector?
Yeah, generally speaking, I'm not an industry expert, but I also agree that I don't see as much cash flowing into the ag sector. That's not because that's not important, right? But it's more about, because venture isn't about necessarily making money, because a lot of companies make money and profitable, and it's great family business. But venture, when you think about their business model, is 80-90% of their companies fail. So when they're investing in a company, they have to believe that if this company pans out, it's going to return over 10x. So the question is, in ag tech, whether that kind of explosive growth or profitability is as available. That would be one thing I would think about. And also ag tech, I don't know what would be the kind of the life cycle, but if you are looking at, SaaS company and they develop something, and it can be based on some brilliant idea or a brilliant person, and then comes up with something useful to oracles of the world, and then the company gets acquired at a profit, then you make a good margin. Ag tech, I don't know if traditional players, the old guards, are as acquisitive. And this is me talking from my ignorance, but that may be something that investors look at.
Yeah, I think just adding a couple of thoughts personally around climate. I think that you can see from the current administration less of a view on subsidy, which is really going to be a focus on the value of an end product on a standalone basis. And so the question becomes, and looking at climate and power and energy and things, there's clearly, with AI and seeing a lot of work on the grid and resiliency and pieces, that there are aspects of what might have been a traditional sort of climate application that's cleaner or better, but that could be the right complementary aspect for helping to build the grid, whether it's battery power or solar or wind or whatever it may be, that it may not be that it's incentive and subsidized by federal funds, but that it could be a valuable additive piece to the economic puzzle that's happening. And so I think that the perspective that Sale added there as well is that in venture, folks are looking for power law outcomes. The question doesn't become that those aren't great ideas or interesting businesses. Does it fit into the thesis of the capital that's out there? And when you think about climate and energy, it's an adjacent fuel source for AI and otherwise. There will definitely be interest in leaning in on those cases. And I think in ag tech, it's interesting. It's a question of application. Is it going to be automation on tractors? Is there big data? Can you fly drones and view crops and manage things? And in a world, again, global supply chains, and should our soybeans or corn be going somewhere else than where they are now, would that focus on supply chain, on aspects and the data and understanding, and when you overlay AI on the data gathered by cameras and pictures and sensors and hardware deployed, what is the ultimate value of that stuff? It might not feel like ag tech, but if it's adjacent enough and has the margins to lean in on it, it could, because agriculture is such a huge business. It's just got to find, for venture investors, that power law outcome inside of that vertical with the right margins, with the right profile, with the right explosiveness that folks are seeking to delight their LPs.
And I would also want to just supplement what I said. I was being very general and speaking about VCs. There are a bunch of other investors who are not VCs, by the way. There are corporate investors, there are private equity funds that kind of take profitability more important than growth and all that stuff. So when I see investments in energy and ag tech and other areas, maybe you don't see as much VC activities, but there's still a ton of private equity and other alternative investor activities. If you have good technology, then most corporations operating in that field would see that as a growth opportunity, for example.
So we have an interesting question on warning signs. When disruption hits, what's the earliest signal that tells you execution is about to break? And where does that signal usually live before it shows up in the system? I think they're looking for financial benchmarks. Hunter?
Yeah, I think that it's a broad question. I'm not sure I can put a laser pointer on exactly what you're seeking there, but I think that there's so many measurables now, and making sense through the noise and the trends is important. I mean, the markets being one and their response to different stimulus is important, but I don't think if any one of us knew we could predict the future, and I don't think we can. But there's a lot of noise, there's a lot of signal, there's a lot of news coverage, there's a lot of this, and as we were talking about AI, we're talking about earlier, Delaware not being as important for founding of startups. That's like a singular event for Elon Musk, who's in his own category of interest in the governance of Delaware that maybe isn't as relevant for us. And so I think that it's going to be really hard for us to predict the future. But I think that the cumulative signals, and if you think back to the bank issues in 2023, what was the signal? Was it stop trading of the stocks? Was it the transfer of funds? Was it enough noise on Twitter that people were responding? It's really hard to know exactly what that signal is and whether or not the market will, or the outcome for you will care.
And to add that from the AI bubble perspective, when you think about how private company valuations are determined, it's determined by a very small number of people, usually the CEO and the lead investor, versus when you compare that to public market, it's crowdsourced, right? Based on a lot of information a lot of people have access to. So when you think about a company, let's say a company raised a lot of money at very high valuation, let's say 10 billion, look at like public market and which companies are valued at close to that range and see their health. And then you can sometimes get a sense that, wow, that's super overvalued on the private company side. And sometimes you don't get that same impression, but oftentimes just comparing to similar companies in the industry that are actually traded on NASDAQ or New York Stock Exchange can give you a sense.
Now, related to that, how common and what's the trend on VC-backed startups creating separate classes of stock with enhanced voting rights? And also, if you could touch on, you mentioned crowdfunding, what the trend for that seems to be like.
So I'll say my piece, and also interested in Hunter's view. Crowdsourcing is generally thought of as something that companies that can't raise VC funding would do. So I don't have a whole lot of experience with that. It's just crowdsourcing is still very cost intensive because of securities law requirements. So I don't see that a whole lot. Maybe other practitioners see more of that. When it comes to dual class, that's mostly for highly sought after like celebrity founders, repeat founders. And even among them, you just don't see them a whole lot. Probably not a majority, but I would say 1 out of 5 repeat entrepreneurs would go for it. What is important is, number one, the fact that you own 90% of voting power doesn't mean you can do whatever you want. Because investors would come in and negotiate their own protective provision so that all you have secured in that case is a negative control, meaning you can block the company being sold, you can block the company being funded, so on and so forth, but you won't be able to unilaterally impose your decision on minority investors. So that's why super voting isn't all that common and a lot of times not worth the cost. And the other thing is super voting class is part of the certificate of incorporation for Delaware corporations, which gets amended at every price round. So what that means is investors will have an opportunity to make that go away at every round. So whenever the company maybe start out with great promise and can justify this early on, but if they take a wrong turn and not performing, then investors may second guess it and can ask you to take it out and condition their investment, further investment on those features being removed. So a lot of times dual class gets introduced pre-IPO when the company has really made it. And then at that time, people really acknowledge that the founders are someone special and they really deserve disproportionate amount of voting power. And it will mean a lot because once the company goes public, typically everyone gets converted to common stock. And in that case, holding 90% of voting power means you can do whatever you want, essentially, because there's no separate class of preferred that has veto rights. So it's going to be more useful after you go public. So a lot of times dual class is talked about on the private side, but sometimes I see that being oversold.
Now, on the venture capital landscape, given the overwhelming amount of capital going towards the big name funds, what opportunities do you think there are, if any, for micro funds or micro LPs?
I think that the smaller funds are going to need to be scrappy and tend to want to be that way. I mean, even just in years past, micro funds and smaller funds have conviction in deploying the capital that they've raised for the outcome that they're seeking. I think that certainly they're not going to be competing with a mega fund on a deal because of just the buying power, unless it's ultimately about access. And so certainly there are folks who are micro funds who could be worried about the implications for these mega funds, but I don't think they're really competing directly. And there's always going to be room for savvy folks to find great opportunities in and around. And there was another great quote, I've forgotten exactly where it came from, but it's really hard to, 5x a big fund like that. And it's a lot easier to, the outsized outcomes come from the earliest and smallest players winning big, because it's really hard to multiply those huge funds.
And from company side, oftentimes size matters because if you're raising your Series A, you want to raise from someone who can follow on. So if you're raising from a very small fund, maybe they're tapped out soon, right? So they can't really do growth size investments. So that's a consideration. But at the end of the day, I don't know if people focus on that as much as who's championing the investment on the VC side. So it's usually good companies tend to draw multiple term sheets and they look beyond the brand. They look at who's behind it, right? Who's going to come join their board and attend board meetings and care, right? So when you look at their biography, it's all people, right? It's not necessarily the shop or the brand, it's people. And you look at, are they collaborative? And then they do cross checks with other founders that they invested in. And maybe they look at, what's your kind of history? Were you a former banker or are you a former founder who has gone through a similar journey as I did? In which case, maybe you're more risk tolerant and you'll take my side and work for the vision, right? So there are those considerations. I think those probably will outweigh necessarily the amount of capital they have in their funds.
Well, we have a great flood of questions still in the Q&A, so let's move to a fire round. Sale and Hunter, please go with your gut answers on these questions, and let's see how many we can tackle before the hour. Sound good? So back to Acquihires. What are your thoughts on reverse Acquihires and employee impact, as well as partial team Acquihires?
So I think it's still developing, but if I'm an employee joining a company and I'm following a star founder and I'm worried the star founder may leave and then I would be stuck with this company, maybe I want some protections around it. We are not seeing a whole lot on that, because star founders are stars for a reason and they tend to have all the leverage and there's more supply than demand, I guess. But at the same time, those are the things. Sometimes people say, even today, I had an employee asking for the right to co-sell. So if founder sells, I want to participate, which is traditionally limited to investors, but sometimes those requests come up. Not sure if that's going to stick, but those are the things that I see.
In terms of particular sectors, what do you see happening in health tech and robotics?
There's a ton of interest in figuring out how robotics can be deployed to offset the shortage of human workers out there to supplement that and make folks more powerful. Automation and reshoring and the building of those types of tools is a big focus. And there's a lot of dollars seeking that out. So I think it's a good place to be.
And I thought MedTech had a banner year last year, and you've seen a lot of announcements in pharma and MedTech, especially around JP Morgan, that's happening right now. And that's because you want to have that press coverage in connection with the conference, obviously. On robotics, which is really interesting because when I started practicing, there was some focus on robotics. This was pre-AI. And now people are turning their attention to physical AI, and robotics is getting valued at a very nice way. But at the same time, applying AI to software virtual space versus physical world, that may be a very different problem to solve.
What are the best types of companies to start in 2026?
Can I say AI companies?
I think it depends
Okay.
what success means to you and what is that? What does the best mean?
Yeah, because nowadays saying an AI company is insufficient. They always say, okay, everyone uses AI. That doesn't tell me anything. So tell me how you're using AI, why that's going to be your difference maker, and how that will eventually make you more money. So I think it's industry agnostic. I don't think you want to avoid AI. AI is going to be part of most industries, if not all, but it's more use case and ultimately come down to economics.
All right. Final question. What do you see in the cards for 2026? Where's the most opportunity for founders and angel investors? Hunter, if you'd like to start, and then Sale, if you could close it off. Thank you.
I think it's a great time to be a founder. There's a lot of capital out there. There's a lot of interest in new ideas, and with a lot of the barriers to entry to starting your company, to incorporating your company, to testing your product, to building things out, to creating awareness, and not just like starting a company to solve a problem, but to lean in on scaling a solution. The path to solutioning and scaling and delighting customers and whatever it may be it's a fantastic time to be tinkering and thinking about big ideas. So honored to be here and spend time with you all.
And I don't think this year will be all that different from prior years. The mantra is repeat founders with historical relationships with VCs will get funded at a much higher rate. That has never been doubted. And then people complain about haves and have-nots, but at the same time, I draw their attention to, do you think anyone is born as repeat founder? So you should really take a long-term perspective and actually look at the history and see how repeat founders became what they are. And then you probably start that journey sooner rather than later.
We are at the hour. Sale, Hunter, thank you so much for joining this masterclass, and to everyone else who joined. The 2026 playbook doesn't end here. We'll share key takeaways on LinkedIn as well as the recording. Let's connect and continue the conversation, and we'll see you next year. Thanks, everyone.
Thank you.
Thanks.